Imagine it. July 1944. The Mount Washington Hotel in Bretton Woods, New Hampshire, is buzzing with anticipation. Delegates from 44 allied nations have arrived, not just to negotiate the end of a war, but to shape the architecture of the global economy for decades to come. Inside that grand hall, the world's financial order is about to be rewritten. Britain, once the unchallenged ruler of global trade, is exhausted. Its national debt has soared to 249% of GDP, a number almost unimaginable today. Its military has been stretched to the breaking point after 2 devastating world wars. The empire that once ruled the seas and controlled a quarter of the globe's landmass is, in financial terms, broken. And yet, in a gesture that has only happened a handful of times in history, the delegates around that table are about to hand over the crown of the world's reserve currency. The British pound, which had dominated global trade for over 2 centuries, would cede its position to the United States dollar. But this is not just a financial transaction. It is the continuation of a pattern that has repeated itself for more than 500 years, a cycle of rise, peak, overreach, and eventual collapse. Every major global reserve currency has followed this same arc, and as we examine the present, the signs are emerging that the dollar, now 8 decades into its reign, may be following the same trajectory. To understand this pattern, we must start at the beginning. In the mid-15th century, the Portuguese real emerged as the world's first true reserve currency. For about 80 years, Portugal dominated global trade, not through sheer luck, but through revolutionary innovation. Portuguese navigators charted new sea routes to Africa, India, and the Far East, opening channels of commerce that bypassed the old overland routes blocked after the fall of Constantinople in 1453. Lisbon became the hub of a new age of discovery. The Portuguese real was accepted across continents, a medium of trade trusted from Europe to Asia. At the height of Portugal's influence, its empire spanned Africa, India, Malaysia, and even extended into Japan and China through Macau. But with global reach came overreach. Maintaining forts, fleets, and trading posts across 4 continents drained the treasury. Rival European powers, the Dutch, the British, the French, were rising, eager to challenge Portugal's monopoly. A royal succession crisis in the 1530s destabilized the kingdom further. By 1580, Portugal had lost its independence, absorbed into the Iberian Union under Spain. The Portuguese real faded, replaced by a new global standard, the Spanish silver dollar. Spain's ascent was fueled by a remarkable stroke of fortune: the discovery of massive silver deposits in Potosí, in the Bolivian Andes in 1545. For decades, Potosí produced nearly half of the world's silver. The Spanish minted coins, the famed pieces of 8, that became the first truly global currency. From the 16th century through the 19th, the Spanish dollar was a symbol of stability and trust, even serving as legal tender in the early United States until 1857. But Spain, like Portugal before it, fell victim to the perils of overextension. By the late 16th century, military campaigns, inherited debt, and repeated defaults eroded its economic position. Philip II inherited a mountain of debt and faced chronic deficits. He defaulted on loans multiple times, leading to inflation that quadrupled prices during his reign. When silver inflows slowed under Philip III, Spain's economy crumbled, and by the mid-17th century, the Iberian Union disintegrated. Spain's dominance, spectacular though it had been, ended. As one power fell, another rose. In the 1600s, the Dutch Republic emerged as the new financial center. Amsterdam became the hub of global commerce, pioneering innovations that shaped modern finance. The Dutch guilder, backed by an efficient banking system and global trade networks, became Europe's de facto reserve currency. The Bank of Amsterdam offered reliable systems for international payments, while Dutch merchants invented stock exchanges, marine insurance, and instruments like publicly traded company shares. For nearly 8 decades, from the mid-17th century to the early 18th, the Dutch guilder dominated global trade, accounting for roughly a third of international transactions. Yet, even the Dutch were not immune to the forces that had felled Portugal and Spain. Military overreach, particularly during conflicts like the Fourth Anglo-Dutch War from 1780 to 1784, drained the nation's resources. The Dutch East India Company, once a symbol of global economic power, collapsed under the strain of these conflicts. By the late 1700s, Britain had positioned itself to take the next step on the world stage. The British pound sterling, backed by industrial might and an empire that spanned the globe, became the world's dominant currency. For over 2 centuries, from the early 1700s to 1944, the pound ruled international trade, longer than any modern reserve currency before it. At its height, over 60% of global trade was invoiced in pounds. London became the financial capital of the world, a hub for commodities, insurance, and global investment. The gold standard, formalized in 1816, reinforced the pound's stability. By the 1920s, Britain's empire controlled hundreds of millions of people, and its currency seemed untouchable. But history, once again, revealed a familiar story. World War I catapulted Britain's debt from hundreds of millions to over £7 billion by 1919. World War II would be even more devastating. Britain emerged victorious, but financially hollow. By 1945, its debt reached 270% of GDP. Victory came at the cost of global financial leadership. This brings us back to the Mount Washington Hotel in 1944. Delegates from 44 nations gathered with a single purpose: to rebuild the shattered global financial system. The result was the Bretton Woods Agreement, which created the International Monetary Fund and the International Bank for Reconstruction and Development, later known as the World Bank. Most importantly, the system pegged major currencies to the US dollar, which itself was convertible to gold at $35 per ounce. The dollar officially replaced the pound as the world's reserve currency, marking the beginning of the American financial era. In the post-war decades, the US dollar became the backbone of the global economy. Even when President Nixon ended the dollar's convertibility to gold in 1971, the currency maintained its supremacy. The key to this was oil. Following the 1973 OPEC crisis, the United States struck a deal with Saudi Arabia. Oil would be priced exclusively in dollars, creating artificial global demand. By the mid-1970s, this petrodollar system ensured that nations needed dollars to secure energy, allowing the U.S. to run deficits unimaginable for any other nation. For decades, dollar dominance seemed unshakable. By 2000, more than 70% of global reserves were held in dollars, but the signs of change are already emerging. By 2024, the dollar's share had declined to 57.8%. Foreign holdings of U.S. Treasury securities, once exceeding 50% during the 2008 financial crisis, have now dropped to around 30%. Countries are exploring alternatives. The BRICS nations, Brazil, Russia, India, China, and South Africa, have expanded to include Egypt, Ethiopia, Indonesia, Iran, and the UAE, creating financial systems that bypass the dollar entirely. Payment networks like BRICS Bridge aim to settle transactions using central bank digital currencies, signaling the rise of a multipolar monetary world. Meanwhile, America's own balance sheet is under strain. By March 2025, public debt had reached $29 trillion, with additional intragovernmental holdings bringing the total to $36.4 trillion, 124% of GDP. This mirrors a recurring pattern in history. Portugal, Spain, the Netherlands, and Britain all experienced overextension through military spending. debt accumulation, and the erosion of productivity, followed by decline. History is not destiny, but the rhymes are hard to ignore. Every reserve currency has lasted roughly 95 years on average. The US dollar has reigned for 81 years. The signs of the four stages, rise, peak, overextension, and collapse, are visible. The question is no longer if, but when, the global financial system will shift once again. After Bretton Woods, the United States entered what many call the American century. Its industrial and military might, combined with a relatively untouched homeland after World War II, gave the dollar unmatched stability and credibility. From the factories of Detroit to the trading floors of Wall Street, America became the engine driving global economic growth. The dollar wasn't just money, it was the backbone of the global financial system. By the 1950s and 1960s, nearly every major commodity, every major trade agreement, and most international investments were denominated in dollars. The U.S. held more than half of the world's gold reserves, further reinforcing confidence in the currency. Nations accumulated dollar reserves not only for trade, but as a safeguard, a store of value in a world still recovering from the devastation of global conflict. The dollar became synonymous with safety, reliability, and power. Yet beneath the surface, cracks were beginning to form. America's military obligations were expanding. From the Korean Peninsula to Southeast Asia, the U.S. found itself engaged in conflicts that cost billions of dollars and countless lives. Simultaneously, domestic spending was rising. The post-war boom had created prosperity, but also a culture of entitlement and expectations for continuous economic growth. By the late 1960s, the sheer volume of dollars circulating in the world outstripped the gold backing the currency. The situation was becoming unsustainable. In 1971, President Richard Nixon made a decision that shocked the world. He suspended the dollar's convertibility into gold. The so-called Nixon shock ended the Bretton Woods system. Suddenly, the dollar was no longer anchored to a tangible standard. Many predicted collapse. Yet, instead of crumbling, the dollar adapted. It found a new anchor in oil. The oil crises of the 1970s reshaped the world. After the 1973 embargo, the U.S. negotiated a strategic deal with Saudi Arabia. In exchange for American military protection, Saudi Arabia agreed to price and sell its oil exclusively in dollars. Soon, every OPEC member followed suit. This petrodollar system created an artificial global demand for dollars. Countries needed the currency not just for trade, but to secure energy, ensuring that the U.S. could maintain high levels of spending and debt without facing immediate financial collapse. For decades, the petrodollar system insulated the dollar from the vulnerabilities that had felled earlier reserve currencies. The U.S. ran deficits that would have destroyed any other nation's currency. By the 1980s and 1990s, it was clear that the dollar was unmatched in both reach and influence. At its peak in 2000, more than 70% of global foreign exchange reserves were held in dollars. Central banks, governments, and investors all relied on the stability and liquidity of the U.S. currency. The American century seemed secure, invincible even. But the seeds of decline were already sown. The global financial crisis of 2008 revealed deep vulnerabilities. Foreign investors, who had long been willing to hold U.S. debt, began to reduce their exposure. The share of foreign-held U.S. Treasury securities fell sharply. At the same time, other nations began actively seeking alternatives. The BRICS nations, Brazil, Russia, India, China, and South Africa, recognized the dangers of over-reliance on the dollar. They began laying the groundwork for financial systems that bypassed U.S. influence entirely. By 2025, BRICS had expanded to include Egypt, Ethiopia, Indonesia, Iran, and the UAE. Together, they are developing the BRICS Bridge Payment Network. a system designed to settle transactions using central bank digital currencies. This is more than a technological innovation, it is a geopolitical statement. It challenges the fundamental structure of the dollar-dominated global financial system. Meanwhile, domestic pressures in the United States are mounting. Military spending alone, including commitments in the Middle East and Asia, has cost trillions. Public debt has risen to $29 trillion, with additional intragovernmental holdings pushing total obligations to $36.4 trillion, 124% of GDP. Federal deficits continue to expand, and social programs, healthcare, and infrastructure demands strain the budget further. Every reserve currency before the dollar, Portugal, Spain, the Netherlands, Britain, faced similar patterns of overextension. History is echoing once again. The warning signs are clear. Global reliance on the dollar is shrinking. The share of reserves held in dollars fell from over 70% in 2000 to 57.8% by 2024. Demand for U.S. treasuries is weakening. The petrodollar system, while still in place, faces competition as alternative energy markets grow and nations seek to diversify their financial arrangements. Multipolarity is emerging not just in economics, but in geopolitics. The U.S. no longer holds uncontested global influence. This is the fourth stage of every reserve currency's life cycle: overextension and decline. Portugal's empire crumbled under the weight of military overreach. Spain defaulted repeatedly on its debts despite its immense silver wealth. The Dutch bankrupted themselves in wars with Britain, and the British Empire, after 2 world wars, lost the financial crown it had held for centuries. The United States, with 900 military bases in 130 countries and a total debt exceeding its GDP, is showing the same historical markers. Yet, unlike the past, the transition may not result in a single successor. The global financial landscape is changing in ways that suggest a multipolar system may emerge. China, with its Belt and Road Initiative, digital yuan, and massive foreign reserves, is a strong contender. India is rapidly modernizing its financial infrastructure, while Russia and the Gulf states leverage energy and regional influence to strengthen alternatives to the dollar. The world may no longer rely on one dominant currency. Instead, multiple reserve currencies could coexist, each representing a block of geopolitical and economic power. History also shows that transitions are rarely instantaneous. Britain's decline was gradual. Its economic power eroded over decades, even before the pound lost its status. Conversely, the Dutch collapse was relatively sudden. The U.S. may experience a slow erosion of dominance, punctuated by crises that accelerate the shift. This could unfold over the next 2 decades, or it could be catalyzed by a financial shock, geopolitical conflict, or a rapid technological change in global payments. Understanding the historical pattern is crucial. Every reserve currency, Portugal's real, Spain's silver dollar, the Dutch guilder, the British pound, followed a life cycle averaging 95 years. The US dollar, now 81 years old, is approaching the stage in which decline becomes visible. Indicators such as shrinking foreign demand, alternative financial systems, and unsustainable debt levels are the same patterns that preceded the fall of every global currency before it. Yet, this is not just a story of decline, it is a story of transition. Every collapse has also been a beginning. Portugal's fall gave way to Spain's rise. Spain's decline opened the door for the Dutch. The Dutch gave way to Britain. Britain's retreat allowed the U.S. to rise. Understanding the cycles of history allows us to anticipate the next phase, not with certainty, but with informed insight. In this context, it is important to recognize that while the dollar's dominance may wane, the United States will remain a powerful economic actor. The world may shift from a unipolar system dominated by one currency to a multipolar system where several currencies share influence. This could bring both stability and complexity, as nations hedge against reliance on any single power. And yet, even as new powers rise, the lessons of history are clear. Fiscal responsibility, sustainable military commitments, and innovation are key to maintaining influence. Overextension, debt accumulation, and dependence on artificial systems to prop up a currency ultimately lead to decline. The question is no longer whether the dollar will face this reckoning, but how the world will adjust when it does. As we move further into the 21st century, the question is no longer whether the dollar's era will end, but how and when the transition will unfold. History offers patterns, not certainties. Every previous reserve currency, Portugal's real, Spain's silver dollar, the Dutch guilder, and the British pound, lasted roughly 80 to 220 years, averaging about 95. The US dollar, now 81 years into its reign, is approaching the historical tipping point, and the signs of overextension and systemic stress are clear. The first major indicator is declining global reliance. In the past, a reserve currency was nearly ubiquitous, used in over 60% of international trade. At its peak, the US dollar fulfilled this role. By 2000, over 70% of global reserves were held in dollars. Today, that figure has fallen below 58%. Central banks, sovereign wealth funds, and private investors are diversifying. Countries like China, Russia, and members of the expanding BRICS coalition are building financial networks and digital payment systems designed to bypass the dollar. The BRICS Bridge Network is a prime example. 10 BRICS nations, alongside 13 partner countries, are creating an infrastructure for central bank digital currencies. The goal is to settle trade, investment, and cross-border transactions without the US dollar as an intermediary. By building these alternatives, these nations are effectively hedging against what they perceive as systemic risks in dollar dominance. This is not theory. These systems are already under development, signaling a deliberate push toward a multipolar financial world. Energy markets are shifting too. The petrodollar system, which ensured continuous global demand for US currency, is weakening. Alternative energy sources, the growth of renewable infrastructure, and strategic partnerships among oil-exporting nations are reducing dependence on the dollar. Saudi Arabia, once the linchpin of the system, is diversifying its own economy through Vision 2030 and engaging with BRICS nations. Even as oil remains vital, the guarantee that every transaction must be conducted in dollars is eroding. Internally, the United States faces structural challenges. Its public debt, now $36.4 trillion, including intra-governmental holdings, exceeds its GDP. Social obligations, healthcare costs, and defense spending continue to rise. Military overreach, exemplified by 900 bases in 130 countries, strains resources further. Fiscal deficits and interest payments consume a growing share of government revenues. The historical pattern is familiar. Portugal, Spain, the Netherlands, and Britain all suffered similar overextension. Military ambition, combined with unsustainable debt, was always the precursor to decline. Yet there is a critical difference today. The global system is more interconnected and technologically advanced than ever before. Digital currencies, blockchain networks, and high-frequency trading have created alternatives that previous powers could never have imagined. These technologies allow nations to bypass traditional financial infrastructure, reducing dependence on any single currency. In effect, the dollar may not be replaced by a single successor, as happened with the pound or the guilder. Instead, a multipolar currency environment could emerge, with several nations, currencies sharing influence and reducing the vulnerability of the global system to the collapse of one dominant power. China is at the forefront of this shift. The digital yuan, combined with its Belt and Road Initiative, positions China to expand financial influence across Asia, Africa, and parts of Europe. India, with rapid economic growth and digital banking infrastructure, is emerging as a significant force. Russia leverages energy exports and regional influence to strengthen alternatives to the dollar. Even smaller nations in Africa, the Middle East, and Latin America are actively building financial autonomy, often through digital currency initiatives and regional trade agreements. The rise of these alternatives signals that the next era may be characterized by shared influence rather than domination by a single currency. The historical cycles provide insight into possible scenarios. Some transitions are slow and deliberate. Britain's decline, for instance, spanned decades. Its economic and financial power eroded gradually, even as the pound remained in circulation. Other transitions are rapid and abrupt, like the collapse of the Dutch guilder during the wars of the late 18th century. The U.S. could experience either path. A gradual shift would allow time for global adaptation, while a sudden shock, whether financial, geopolitical, or technological, could accelerate the redistribution of influence in unpredictable ways. There are also lessons in resilience. Even as previous powers declined, they did not disappear entirely. Portugal, Spain, and the Netherlands retained regional influence, cultural legacy, and economic relevance. Britain, despite losing its empire, remained a major global financial center. The U.S., even if the dollar's dominance fades, is likely to remain a central player due to its technological innovation, productive economy, and strategic alliances. Decline in reserve currency status does not equate to collapse. It signals a redistribution of power in a more complex and multipolar world. Yet timing is critical. The average lifespan of a reserve currency is about 95 years. The dollar is 81 years old. The signs of transition are evident: decreasing global market share, rising debt, military overextension, alternative payment systems, and the erosion of the petrodollar. These are not isolated anomalies. They are repeating patterns that history has documented over 5 centuries. The next decade may be decisive in determining whether the shift is gradual, measured, and orderly, or sudden, chaotic, and disruptive. The implications are vast. For global investors, understanding the trajectory of the dollar is crucial for managing risk and exposure. For policymakers, recognizing the signals of decline allows for strategies to mitigate shocks and preserve stability. For citizens, these shifts affect everything from purchasing power to job markets and international relations. The cycles of reserve currency history are not merely abstract. They have tangible effects on economies and societies around the world. Looking forward, we may enter a truly multipolar financial world, one where dollars, yuan, euros, and digital currencies coexist, each representing different blocks of economic and geopolitical influence. Such a system could encourage stability by distributing risk, but it could also introduce complexity as nations navigate multiple competing standards for trade, investment, and reserves. The lessons of history suggest that overextension and debt, if left unchecked, will always trigger recalibration. The dollar, like all its predecessors, may face a similar reckoning. Ultimately, history does not repeat perfectly, but it rhymes. Portugal, Spain, the Netherlands, and Britain all rose, dominated, overextended, and eventually ceded financial leadership. The United States is following a trajectory that mirrors these cycles in striking detail. The difference today is the global scale, technological sophistication, and interconnectedness of economies, which may both delay and complicate the transition. The only certainty is that the era of a single, uncontested global reserve currency is approaching its twilight. The dollar's dominance, while still formidable, is no longer guaranteed. Emerging powers, multipolar systems, and digital alternatives are rewriting the rules. As history has shown, Transitions of this scale are rarely immediate, but inevitable. The future will likely belong to a system that is more complex, more interconnected, and more shared than ever before. The patterns of history are clear, and the question is no longer if the dollar will decline, but how the world will adapt when it does. Will the shift be gradual, giving nations time to adjust? Or will it come suddenly, reshaping global financial power almost overnight? One thing is certain: the cycles of rise, peak, overextension, and transition have defined global finance for over 5 centuries. The next chapter is unfolding now, and the choices made in the coming years will determine who leads in the multipolar world of tomorrow. History is not merely a record of the past, it is a guide, a caution, and a lens through which we can anticipate the forces shaping our future. And if the rhymes of the past hold true, the twilight of the dollar's dominance is approaching. The question is no longer whether the American century will end, but what the world that follows will look like.